So let's talk about the two types of market participants we have in the stock market. The first example we have are retail traders, and the second are institutional traders. Now, institutional traders are hedge funds, banks, algorithms, and other big institutions that are managing a big pool of money. Retail traders, on the other hand, are us, and we'll call this small scale. And that's comparative. Small can mean thousands of dollars worth of volume, even into millions. Now, conversely, institutions are trading in the billions of dollars. So their trades are significantly larger since they are managing pools of money. Now, the big differences are retails are smaller scale. We do not have enough size to move the market. And most importantly, when we want to buy or sell, we can press the button and get filled almost instantly. Institutions, on the other hand, can literally dictate where price goes in the market. Their positions are so large where if they want to buy 1 million shares compared to our 100 shares, they can't just simply press the buy button and get filled. Because if they do, the market can rip through the price that they want and they get stuck with a terrible fill as liquidity drops. Now, liquidity, simply explained, is the amount of instant shares available in the market. So, how many people are buying and selling shares? At a given moment, we could say there's maybe 10,000 shares available. So, if we're buying 100 shares, we're pretty much not doing anything to this. But you can imagine when we're buying 1 million shares of orders, the market will not be able to fill this order and will just continue going up and up to find a price that is willing to sell, or in this case, down since we're selling. Now, what does this mean for us? Our job as traders isn't to dictate where price can go because obviously we cannot control that. But what we can control is we could find the footprints, and we'll put it right here, footprints that, spelled that wrong. Footprints that institutions leave behind. And some of these footprints can include swing points, key levels, and momentum, which we'll be discussing next. But for now, we understand that institutions are trading super large scale. They cannot get rid of their positions very lightly as they have liquidity constraints compared to us where we can buy and sell shares almost instantly. They have to do this in a much more discreet way. And when they do this, they leave around these footprints that we can then identify, find out which orders they're trying to sell, and almost front run them. And as I like to call it, join the smart money. Smart money being these institutions. Now, I hope that explains the difference between retail traders and institutions, as these are the two market players or participants, and how each one affects the market.